Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Relations here. Actually, cut. Take two. I am not Director of Investor Relations. I don't know. Okay, we're taking it from the top. All right. You ready? I'm ready. Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited to be joined today by Devin Elder. Devin, welcome to the show.
Whitney, thanks so much for having me. How are you?
I am doing fantastic. We're in sunny Sedona. We've escaped the cold Colorado weather.
All
Uh,
right.
so I'm loving life, but we go back next week. So well, let's dive in if you don't mind, because I know there's plenty of details to go over here. Let's dive in, or actually, before we dive in, let's talk about a little bit about yourself, how you got in the multifamily space, and where you're at today.
Sure. Yeah, I'm born and raised in San Antonio, Texas. Married for 16 years. We have three children. Um, and I'm San Antonio through and through. Grew up here, went to University of Texas, San Antonio, graduated there, worked at two of San Antonio's larger employers for about a decade. So kind of got my feet into the corporate world. And along the way there, I started reading books on entrepreneurship and had a brother who was an entrepreneur, and it really piqued my interest. I think ultimately it fit my personality more. I like a lot of stimulation. I like a lot of projects. I've always worked two jobs or worked a job and gone to school growing up. So I like working. I like staying busy. I like interesting projects, and found that I wasn't really getting that out of the corporate roles I was in. So I attended a seminar. I paid for a mentorship, and I started doing some houses. We'd buy the house, fix it up, refinance out all the money, and then you have equity and cash flow and appreciation and tax advantages. And I thought, well, this is really neat. I wish somebody would have showed me this in high school. I have a bunch of these by now, but that's okay. Went pretty gung ho for about 2 years doing that and building up a base of assets and capital and experience until the point where really there was a high opportunity cost to go into my six-figure corporate job where it was like, there's a comfortable job, but my real estate business is already replaced my income, and this is on a part-time basis. I was working very hard, and I was working after hours and weekends while having a day job and a family, but still couldn't dedicate all my time to it. So my thesis was if I could give it all my time and energy, I bet we could really grow this. I already had a small multifamily at that point, had about 22 doors, had done a bunch of rehabs, had done a bunch of refinances, kind of had the lay of the land. Got into a 75 unit apartment complex with some partners that kind of stepped me up into that bigger tier. What I found is the small multifamily 5 units, that kind of thing, it's just really not even the same animal as say a 100 or 200 unit apartment. So I had gotten into there, and then when I went full time and formed my company, I was already in the multifamily world, and from that point, kind of had the playbook of buy a large multifamily asset, 100 plus units, bring in a lender, bring in some investor equity, and go through and upgrade these things, go in and renovate units and so on and so forth. So that's been kind of our journey, how I started. Today, we're at 70 employees in San Antonio, Texas. We've got 2,500 units under management currently that we own and manage. And then we also do some other stuff. We do a lot of rural land, totally different asset class, and we like shallow bay flex industrial, totally different asset class as well. But we've grown into some other asset classes over the last 12 years or so, and the common denominator is that we own and operate them, and they are pretty much in and around San Antonio, Texas. So after this, I'm going to drive to one of our assets. Just looked it up on the map. It's 15 minutes away, and I bet we could plug in most of our assets. They're 15 minutes away. I had a lender tour this morning with two of our multifamily assets. Started at 9 a.m. We were wrapped up by about 10:15. So I like being local. I like being in close proximity to these things, but that's kind of our scale and scope today and what we're up to.
Awesome. Well, thank you so much for sharing, Devin. And let's touch on one of those multifamily assets. Stratton Park, 127 units, San Antonio, Texas. No surprise there.
That's right.
When did you close on the property and what was the purchase price?
Sure. We closed on this in February of 2024, so less than a year ago, depending on when you're hearing this. But as we're speaking, it's less than a year ago. Texas, is, as some listeners may know, is a non-disclosure state, meaning that the sales price of assets is not recorded and readily available. We also have our taxes reassessed every year by the county. And so as a result, you're going to find Texas people are not talking about their prices a lot in very direct terms because you're kind of working with the county to try to keep your taxes low. You know, if you look at a P&L on a multifamily, your taxes every year in Texas rather might be the single biggest line item, you know, even right up there higher than payroll, which is another line item that can be one of the biggest ones. So we're always working our taxes. As such, we're not forthcoming in Texas oftentimes about a purchase price. I would say that we bought this for under 100 per unit on a 127 unit asset.
No, and I think a lot of people were like, "What? Why wouldn't you just like state it on a
Come out
podcast?"
with it.
Well,
Sure.
because some of the county administrators actually listen to the podcast.
That's
So
right. That's right.
you don't want to be advertising that. Or they
Correct.
just have to, do a quick Google search and the title of your podcast. Devin bought a 50 million unit apartment building.
Right.
Okay.
Right.
Yep.
Ask AI, and it's just going to spit it out. Right.
Well, all right. So now that we kind of have a little bit of context here around like what you purchased it for, let's talk about let's back up the timeline a little bit. When did you find this property and how did you find it?
We found it in late 2023. This was it was actually a marketed deal. So, you know, the idea that, you know, we had to send letters or call 1,000 people. It's not really the case here. What I found is that that's not really the case for the larger multifamily, call it 100 unit plus. I think there's great value to be had, you know, if you're the type of owner that wants to go out and own 10 units and buy it from a mom and pop and send postcards and knock doors, make phone calls. I think you could get a really good basis. That's just not I've owned those. That's not the asset class we play in. So if we're playing in larger assets, you know, $10 million plus purchase price, 100 plus units, typically these are going through brokers, whether they're marketed officially or they're off market. So the name of the game there really is broker relationships and then ability to execute. I mean, that's really all the broker is concerned about. If he's bringing his client to you and the deal, they just want to know if you can execute. So it's an unfair advantage to be operating in a marketplace where we can point to deals. I kind of chuckle about this. We'll see a deal marketed with 5 comps, and I go, hey, we might pursue this deal. Look, 2 of those deals are our assets in the comp set, right? So we're actually buying a deal right now that is next door to one of our assets. I mean, literally the next building over. So that helps. So to answer your question, this was a marketed deal. It was marketed as a 2-pack in the second half of 2023. We actually knew the owner operator pretty well too. I mean, they're another San Antonio operator, and we're friendly with them. And so good deal of familiarity between the teams there. We really liked the location. It was around the corner from one of our other assets, just kind of right up the middle, north central San Antonio. Really, really nice. I've had friends live in this apartment complex over the years. It was built in 1986. My mother-in-law used to live there at one point. You know, I know I've driven by this property my whole life for the most part, and so very familiar with it. But it's in a good pocket. It's north central San Antonio, north of the airport, and it's just a quiet little pocket. And the asset always showed well. So the larger national broker brought it out as a 2-pack. One of the other assets we didn't like as much, and a lot of times the brokers will do that. They'll bring out a 2-pack and say, hey, you know, we'd sell these separately. So we kind of decided pretty early on, yeah, we just like Stratton Park, so let's go after it. So we did. We put it under contract in late 2023. We thought we had everything pretty buttoned up with the lender. We did change horses on the lender last minute. And this was due to a deal that I'm on. We'll get into the weeds here a little bit with the Fannie Freddie lending. There was a deal that I'm a partner on, like a 1% partners known as a KP or a key principal. Another deal in San Antonio that we don't own and manage, another group does. they'd had a lender inspection last year and the lender didn't like some of the landscaping or something, and they said, "Hey, we're putting this team on a list here that's going to make it more difficult. It's another level of due diligence with Fannie and Freddie." So we're initially going to go Fannie Freddie on the debt. That was creating a tremendous amount of work for the team because of this other deal that I'm a 1% partner on. So we said, you know what, rather than risk this deal, extend timelines. We're going to switch. We get a bridge loan on it, which there's pros and cons. Generally with the bridge loans, you're getting some nice proceeds for rehab, which we really like. For an example, you could get into a deal for 10 million as your day one loan balance, but they might give you another 2 million of future funding that it's not on the loan balance. You're not paying interest on it day one, but you've got some runway to go out over the next year or two, spend some money on renovations, hopefully interior renovations where you're seeing a nice ROI. You're spending $8,000 and you're seeing a $200 a month rent premium, something like that. And so a lot of times these bridge lenders will give you that future funding. So you've got runway, because if you can borrow from the lender at 7% versus raising equity at, an 18% equity target, it's a lot cheaper to get it from the lender. So we did that. We pivoted, and that drug the deal into the new year, into 2024. But we closed it inside of our normal extensions in February, and it was a pretty clean deal. It's actually a little bit smaller for us. We own deals from 60 units to 400 units. You
Mm-hmm.
kind of get some economies of scale up around 200 plus units. So that's where we would ideally like it. But 127 units, the area, the basis, it was relatively lightweight sort of capital improvement plan, already stabilized, that kind of thing. So
Well,
moving.
let's pause here because you gave us a lot to digest and a lot
All
of rabbit
right.
holes to go down.
Yeah.
But and then we're gonna dive deep into like the lending piece here in a second. But I want to stay because a lot of times our listeners are actually listening to these episodes to figure out, they're taking notes. They're trying to like, how did
Right.
Devin close deals? And what does Devin do that I can incorporate into my own due diligence
Sure.
or own systems? And so you've thrown out a lot of things about this being a value add plan. Was that the overarching business plan here? Like you're buying this from another private equity group. Like, was there
Right.
still meat on the bone for you to do a value added strategy? Like, what class of property is this?
Yeah, I would call this a B class property based on the condition of the asset and the location and the vintage, right? Mid 80s.
Mhm.
So kind of a solid B deal. There was a value add component, really mostly on the interior turns. Sometimes we're getting pretty wild on our budgets. If we've got to go do a full rebrand or take it down to 50% occupancy, we've done those properties. This is more of a clean, stabilized. You might pay a little more for something like that because it's less headaches. But if you can programmatically go in on another 50% of the units, spend the money, do those turns that I alluded to. You spend $8,000 and get a $200 rent premium. Then you've got the ability to create some additional net operating income over time. So that was the plan here. I
Absolutely.
would call it a light value add on a Class B deal.
Okay, so we got a pretty good solid property from a group that you know well, from a property that you have like some, history with, like personally, but also
Sure.
within the family, literally.
Right.
So how did you get to your like, putting in a letter of intent, your purchase sale agreement? Did you give the seller initially their purchase price? Was there some sort of negotiation? How did you land on your purchase price?
Yeah, we have our team that runs acquisitions. We usually, I don't say usually, but if something's within kind of 90%, if our numbers are within 90% of the ask price, this was back then. I think now what we're seeing some crazy basis on stuff right now just because of where the market is. So at this point, we're making offers. All bets are off. We're just going to offer anything and not worry about offending somebody because the market's just crazy. And we've seen some really deep discounts. At the time, a year ago, a year and a half ago when we were first initially looking at this, hey, if somebody's asking 10 million, we're getting to 9 million on our underwriting. I feel fine offering there. That's not outrageous, right? So we usually come in at 85, 90% of the ask or whisper price, see if we can start up a conversation there. So that's what we did here. Um, and we came in, we come in a little bit short of the ask price, but um, I think in this case, looking at our underwriting, I think we were 86% to
Okay.
the asking price. So, maybe the asking price was a little proud coming out. And that's fine, but that's where we settled.
And when did you walk the property? Because I'm trying to understand, like, if how did you close the gap? And sometimes that means you actually have to walk the property to fully understand, okay, do the pictures really tell the tale? Like,
Right.
there's something
Right.
else that we need to uncover here.
When I was starting out, I would walk the property at night, basically trespass, right? If I was interested in a property and putting in an LOI, I would go drive it, park there at night, and walk around, see how I felt there in the middle, 11 o'clock at night. Now, because we're operating out of one market and we have a team now, I mentioned we got 70 employees, the likelihood that somebody on the team worked there at some point or their buddy works there is high. So, we can sort of do a lot of desktop due diligence, even though the asset is literally 15 minutes from my office. I've driven by it. I know generally what condition that the place is in. So what our process looks like now is, hey, this deal came out. It met some preliminary tests on underwriting. We might pursue it. Shoot an email out to the team. Hey, we're looking at this deal, guys. What do you think? Oh yeah, and we've got all the data too for what's going on in the market, right? Where are people's rents at? Where are people's occupancies at? How long have they had it? So we're kind of seeing the matrix here on the data that's available to us through various subscriptions and things like that. So we can do a lot, enough. We can do enough desktop due diligence. Again, this is not something 5 states away. It's right there. We go drive by at any time, um, but we're familiar with it. The team's familiar with it. We've got third party data through subscriptions enough to say, yeah, I think we're ready to submit an LOI. So we'll do that without actually walking the property, or maybe one of the team will go over there or somebody from operations go just kind of check on it. But really what we're doing is we want to get into contract and then we want to do our full due diligence. And we usually doing that within 3 days of getting into contract. So we don't want to get into contract unless we're absolutely serious about the deal. We don't want to waste anybody's time. But we can do a lot of that due diligence, underwriting, and everything on the front end. Maybe it's a drive by, but or there's just a lot of internal knowledge about that asset for the team to say, the operations team that's actually going to run it, the property management company that's actually going to run it, to go, yeah, one of our regionals worked there 2 years ago, and we know the manager over there, and their occupancy has been good. Their marketing could be improved a little bit. They're giving us like the rundown of the assets, so enough to say, yep, we're prepared to make an offer here, and then usually you've got a 30-day due diligence period, and that we see that coming well in advance. So we'll schedule our due diligence. We'll bring not the whole, we'll bring half a dozen or 10 people out there. We'll walk every unit, take an inventory of all the units, full site inspection, inspect the roofs, inspect any other major CapEx items. And at this point, we can knock that out in a day. We'll request 2, but we can usually knock out due diligence in about a day. And we're doing that very, very soon after getting in a contract. And at that point, we kind of know after that initial due diligence period whether we're in or we're out. And so at that point, we're just gearing things up with the lender. If we're raising capital in the deal, we'll kick that process into place and march toward a closing date. Usually you've got 30-day due diligence plus 45 to close, takes you to 75 and maybe a 15-day extension. You might be looking at a 3-month cycle here to kind of get all this stuff, all your ducks in a row.
Well, let's talk some specifics about Stratton. So is it, to sound it back, it sounds like you did a 30-day due diligence, maybe 30 to 45-day to close, had that extension on the back end. What kind of earnest money did you put down on the property in order to get it under contract?
1%. So,
Okay.
1% of the purchase price, pretty standard. I don't remember this deal if we did hard earnest money. You were seeing that in the market for a little bit where, hey, you would put up the earnest money and you know, they're keeping it whether you close or not. In a hotter market, more sales transactions, people would do that to win deals. We've done that before. No buyer likes doing it, right? That's really putting some money on the line. So I don't remember if we did hard earnest money or not on this one. We're not seeing that now in this market, but yeah, 1%, send it over to title. Nothing fancy there, and then that money's really not at risk for that first 30 days.
And then let's talk about the specific due diligence on Stratton. Were there any, fun stories that came out of due diligence, or was it pretty much as expected?
We've seen some crazy, crazy things over the years on all of our assets. Stratton, kind of boring. Clean property. There's brick exterior, roofs are in good shape, mature trees. We didn't even rebrand it. That tells you that it was pretty nice. A lot of times we don't hesitate to completely rebrand a property. In this case, it just was like we don't need to expend that capital. It's got a good reputation. So kind of boring, not much fun for the podcast. No big horror stories, pretty clean due diligence. We did end up redoing the office and kind of giving that a makeover. And then we'll do some touch up paint or increase our signage visibility. We'll go in and spend money on online advertising and get our lead flow up. Things, just normal operational things that you do. But it was a clean property, so there just wasn't a lot, there was no police helicopters flying around after a drive-by shooting or anything crazy like that. Have had that happen on a property before. We've seen all kind of stuff, but this one, good area, clean asset, boring story to tell, unfortunately.
Well, what about the financial side? Were there any surprises there?
No, you see that a lot, but we take a seller's T12, a trailing 12-month financials, right? So you give me a T12, what are the last 12 months income and expenses? We'll analyze that, but we're kind of balling that up and throwing it in the trash because you know, it doesn't matter. It doesn't matter what they did. It matters what we think we could do. So we're really looking at the T12 going, okay, they're paying X amount for payroll, they're paying X amount for contract, for marketing, and we might agree with that. We might agree that, hey, you're paying 200K in payroll a year for this size property. Or we may say, no, we can do it for less, or no, we can't do it. We got to bump that up. We might look at their advertising marketing budget, say 10 grand a month is what y'all are claiming to have spent. We think this thing needs more like 15 or 20. That's the number we're going to plug in moving forward. And then we're just going to go down the categories, right? Taxes, insurance, utilities, all that stuff. In general, on a clean property, we're kind of matching up with the seller's financials on, hey, how much are we going to spend on turning units? Yeah, it matches up. If we're seeing a big delta on any line item, if their payroll is 100K a year and our payroll is 50, or our payroll is 150, that's a red flag for us. Hey, did we miss something? Is there a sell off in the formula, or are we just way off base? Or are they, you know, hiding expenses somewhere else? But my point is, we need to we need to just look at it moving forward, what we think we can do based on, our purchase price, and so forth. So again, on this one, pretty clean story, not a lot of delta on the financials between how they were currently operating and how we plan to. So pretty straightforward. This deal for us is just kind of like, we we like San Antonio, obviously. The net migration story in San Antonio is strong. You've got very strong net migration year over year. You got a well-located asset, physically a good asset, and some opportunity to make some upgrades to the net operating income through unit turns. We think over a 3 to 5 year period, we're going to see enough appreciation to get a strong double-digit return for the equity on the deal. So it's kind of one of those deals: buy it, make small improvements, and we'll exit 4 or 5 years down the line. And that was really it. So super long answer to your question. We don't really see any surprises in the financials.
Well, let's talk about the financing on the deal because it sounds like if there is a story on this property, this might be where it is. And so tell us, let's start in reverse. I want to know is the financing term and profile that
Yep.
you closed with? And then let's back it up and like get all the juicy details on how you switched away from Fannie Mae, Freddie Mac.
Yeah, we were initially looking at that just because of you like a fixed rate debt product, you like a long term. The challenge with Fannie and Freddie is your exit costs are often very high, so that there's always kind of a trade off. Ideally, you would be in a situation to um, be able to exit a property in 2 years without an egregious prepayment penalty if you got an offer that made sense. Sometimes with the Fannie and Freddie stuff, the prepay can be tough, even though the other terms might look good. Also, sometimes you're not getting your future funding with the Fannie and Freddie stuff. And then the third component, which I alluded to, was, hey, we had this other deal that was Fannie and Freddie, and the lender didn't like an inspection, and they were running us through the ringer on this other deal. So I'm getting back and forth email, question after question after question after question from a property that we don't run, and I'm going, man, this is gonna this is gonna really burn us up, and we're burning time in our period here. We don't have unlimited extensions. I'm afraid this deal's not going to get done based on all these questions they're asking about this other deal that I'm a small part of. So we just decided there's too much friction going this route, and there's too much risk. And we're going to pivot to the bridge loan where you're getting a 3-year initial term, 2-year extensions. You're getting a rate cap for that 3-year term that fixes your rate. And then you're getting future funding um, that doesn't hit the loan day one, but you can draw on it. And so it's like a construction account would be a way to think about it for maybe the novice listener here. You've got an initial loan of, call it $10 million, but two more sitting there. If you go and do the work, you go turn a bunch of units and spend 150 grand. You take those receipts back to the bank and say, hey, we did all this stuff to fix your collateral, and they will refund you that or reimburse you that money. Now, it's a difficult process. I think the draw process with lenders is probably the least desirable activity in all of multifamily investing. I used to do it myself when we were starting out, and now we have a big accounting team that runs it. It's painful, and you spend the 200 grand or the 500 grand, and then you get all the things and you submit it, and then you wait and you wait, and you're kind of floating that money. So it's not the easy button, but it is access to capital that's lower cost than equity and can give you some nice runway to make those improvements to the property. So that was kind of the pivot behind going to the bridge product. You want to get that future funding to go and do the rehab rather than raise it as equity, which every dollar you raise of equity makes it harder to hit the returns. You're trying to hit returns on a larger pool of equity. So if you can have a smaller pool of equity and use some of those lender dollars at a lower cost of capital for the rehabs, that can help the deal overall, the proceeds of the deal overall.
Well, you said you rate capped it for 3 years. So I am interested specifically, what is your interest rate? What did you cap it at? So let's start there. Let's get some of
Yep.
that, and then I have some follow-up questions.
Sure. Yeah. We capped it at 6.5%.
Okay. And it's starting where?
I don't remember what our spread was on the cap. I just remember that our all-in rate after the rate cap reimbursement gets us to 6.5%.
Okay.
We
Which
got
right
that
now I
locked in.
know a lot of people are asking, at least our investors are asking, hey, where are interest rates going into 2025 for
Sure.
multifamily? Every report I'm seeing is, 5.8 to 6.5. We're going to bounce around somewhere in there. So that's pretty par for the course right now.
Yeah,
Uh,
I mean, we would hope to, refinance if we do. If we don't sell, somewhere in the fives would be great. And you can buy down, if you get into a Fannie product, you can buy down those rates. So, but the debt market is ever changing, as you guys know. But the nice thing is we've seen 100 bips cut from the Fed so far this year, and it's going in the right direction, which is nice and ought to help our industry out.
Definitely. And when that was going to be my follow-up question is like, what is your plan after that, as you approach that 3-year mark?
Yeah, I mean, the
So
easiest one, if was that the question or?
yeah, that's the question, but I've got more. So go ahead. Like if you had more to add, let's do
Well,
it.
the easiest thing is just to do the extension, right? If you're not in a great position to sell or you don't like your refinance options, just buy your extension. Do your extension. There you got another year.
Mhm.
Um, and then you got another one after that. So that's kind of the easy way to do it because refinances can be expensive. So if there's not some big benefit of the refinance, maybe you're getting a much lower rate, maybe you're getting cash out proceeds, maybe you're getting some other really desirable loan terms. Okay, do it. If not, might be best to just extend it. Or, if you're in a place to entertain a sale, I think every quarter or every half a year we'll go out to some brokers and say let's get a BOV on this. It's a broker opinion of value. They'll run the numbers and give you a range of what they think they could sell it for, and if it makes sense, never gonna go wrong taking a profit.
I love that. I love that. Well, you raised capital on this deal, and you've talked a lot about, why you went with the construction debt piece in order to not have more capital that you had to raise for the deal. So, what terms did you offer for your investors, and how much did you end up raising?
Yep, on this deal we ended up raising about $4 million, and then we do a co-invest as the sponsor. So, but from investors, we've kind of done the same profile over the years. We're saying, hey, we've got a 7% preferred return. So, out of cash flow, you're getting 7% on your money first for anything else. After the 7%, there's a 70-30 split. So, the management team or the sponsor, us, gets 30% of the capital, investors get 70% of the capital, all the way up forever. And so we have a very simple split model. It's a 7% pref to investors, and then anything else, refinance proceeds, sale proceeds, excuse me, get split 70-30. So we're basically a 30% owner of the project. Investors own the rest. And then out of cash flows, we're looking for a distribution at that 7%. So what it would look like for an investor on, say, a $100,000 investment is you're getting, if we held it 5 years and you're getting 7%, you're getting 7,000 a year in cash flow for 5 years, you're getting about half of your capital through cash flow. And then at exit, you're getting, your capital, an initial capital return plus the other half to kind of get you to that, 1.9, trying to get close to doubling investors' money over a 5-year period. But that's how it's structured. It's 7 pref, first 7% of profit goes to investors, then a 70-30 split after that. Nice and simple. And we we really don't have anything else than that. There's not an exit fee. There's really not anything else in there that would change the partnership structure.
What about the upfront fees that are charged to the deal, like the acquisition fee, asset management, anything
Yep.
like that?
Yep. We charge a 2% of purchase price acquisition fee as standard on our multifamily deals. We charge a 2% of income, collected income, as an asset management fee. Although a lot of times we just accrue those, we don't pay. It's not very, might be 2 grand a month on an asset. So, we accrue it, but sometimes we don't, we'll just pay it out at the end, so that we're not burdening the property with that extra 2 grand a month. But we do charge that, and we will, get paid out at exit, or we keep it current and pay it. And then we charge a construction management fee, which is 7% of the capital improvement projects. And then acquisition, asset management, there's a property management fee. We charge usually 3% of revenue. We own the management company, so that's one of those you can't really get away from. I mean, you're going to pay somebody a property management fee. We've used third party in the past, and we decided to build our own management company because of that experience. So we're kind of, the deal's paying the property management fee, whether it's third party or whether it's us. So we're just charging sort of market rate. I would say all those fees, acquisition, asset management, property management, are market rate fees, construction management to run the deal, to pay our staff, that kind of thing.
Mm. And that's something that I'm always talking to investors about. And they're like, hey, like, let's lower the fees for the deal. And I was like, you want the operator to be able to keep the lights on to run the deal. So,
Yeah. Yeah. I mean, it's easy to just whip that spreadsheet into shape and show some good numbers. It'd be cool if we could raise rents $500 too. You know, that looks great
oh,
on the
yeah.
spreadsheet. It turns out nobody's going to pay that out there in the world. So yeah, you do want your sponsor to be able to be, compensated for their time. You know, the last thing you want is a sponsor working for free for a long extended period of time. Like that's just it's a misalignment. So I think as an investor, what you're looking for is sort of market rate expenses, right?
Hmm.
If you see a 7% acquisition fee, hmm, well, what are other people? What's market on that? If everybody's charging 2%, 3%, 1%, and you see a 10% fee, well, that's you're just kind of looking for anomalies. What's market rate property management fee? 3, 4%? What are these guys charging? 3, 4%? Okay. I mean, I mean, if you are kind of aligning the deal with market rates for things, I think you're in a good spot.
Well, and I'm glad that you brought that up because there's one as a limited partner investor, you want to make sure that, like you said, the fees are aligned, that the deal structure is aligned, right?
Right.
We want to all make money together.
Sure.
Also, as a limited partner, I would also say, hey, make sure that if the fee is being charged, that the service is being delivered. And I've seen some deals crazy enough in the past 12 months that say they have a construction component on it and they're charging a construction fee. Guess what? No construction. So
Like no
it
construction being done?
no construction being done.
Huh.
So I know. I mean, it's like things
Well,
that make
wouldn't they
you
not
go,
get the fee then, or are they just charging an upfront fee?
great question. And that's something that whenever, every once in a while when I see these pro formas and I'm like, hey, look at this line item, go back and ask that question.
Yeah,
I wish, that I could just call the operator and they would tell me, but they don't.
they're
But
busy.
yeah, I've seen some, but that is one other thing, just to, if the fee's being charged, make sure that the service is actually being provided.
Right.
Now,
Yeah, good
I,
point.
since you have had this property for 12 months, I want to ask you any crazy things since takeover, or has it been pretty like boring and, smooth asset as you expected?
Yeah, we had actually a really tragic event. You know, I was hesitant to bring this up, but you asked. We had a gentleman taking the trash out. He fell down and he was carrying a gun and he killed himself. And it wasn't a suicide; it was an accident, but he died. And it. You know, talked to the team about it. I was like, was this a violence thing? Was this a crime? Was anybody hurt besides this gentleman that's deceased? And just an accident. So be careful with your firearms out there, folks. We did have that happen, and it's a tragedy when stuff happens on a property you own. Ultimately, we provide housing to probably over 5,000 residents in Texas. So there's going to be stuff that just life is going to happen, but that did happen on that property. And, our first concern is the welfare of the residents and the staff, especially with a firearms incident. And so, it certainly got my attention, but turns out it was an accident and, just a tragedy. So, not something you want to see happen. And, that's tough, but that did happen this past year.
I'm sorry to hear that.
Yeah, I
And
was too.
I think you bring up something that, things will happen on properties that are outside of your control. So do you have any insights to share for a newer operator that has something like this happen on their property?
Yeah, I think the first time that um on a property that I owned, it was 130 units. This was years ago, and the property manager called me and said there'd been a shooting, and it scared me to death. I just was like, I felt completely responsible. I felt like I needed to completely protect and provide for every single resident that lived there. And that's just not the reality of it. So my advice to operators is if you're going to run a multi-million-dollar business that involves hundreds of other human beings, Life's going to happen, and there are just some things beyond your control that are going to happen out there. You need to focus on controlling the things that you can, whether it's lighting or security measures or background checks for your residents. You need to have those processes built in. But at the end of the day, you are not God to 300 people. You know, people are going to do their life and make their decisions. And so you just got to focus on your sphere of influence, your processes for safety and your protocols. But my advice to newer sponsors is things are going to happen in the multifamily space, especially the B and C multifamily space, especially as you get larger and have more assets. And that's just the nature of providing housing for thousands of people. So it's going to happen. Focus on your processes and systems for keeping people safe.
Wise words, wise words. Well, Devin, I have two questions to kind of wrap us up with, and I'm going to ask them both at the same time. What did you find easy about this Stratton deal that you thought was going to be a little bit more challenging? And then what did you find that was more challenging that quite honestly you thought was going to be easier?
Yeah, the easy part. Well, let me answer the hard part that I thought would be easy. Changing financing, I don't like doing that, right? We kind of had one plan to go forward with Fannie Freddie, and then we got into it, and then because of all this friction we were running into, we switched to Bridge. I don't like doing that. That was harder than it should have been. We got it done, executed, it's fine. Every deal's got, I mean, every real estate transaction got like some action on it for sure. But I didn't expect that part to be hard. The easy part was it's a great part of town. It's clean. There's not a big heavy lift. There's not a big crime component. That part was easy and super enjoyable and made takeover, a breeze. And subsequent operations made it a breeze, which is awesome.
Well, Devin, I do have a follow-up question there
Sure.
because that is, usually, you're buying a property because there's some sort of distress.
Right.
Why was the seller selling the property if it was such an amazing deal?
Yeah. It was just time to go full cycle. You hold on to a deal, you get 3, 4 years into it, and one of the things I found in multifamily too is these things need a lot of cash. You might find an owner that's kept it for 20 years and their basis is really good. But if you're syndicating, you're looking for a yield and you're looking for that return over 3 to 5 years for a lot of us, right? So if you got a deal and you're 4 years into it, 5 years into it, and you can exit and make your marks on your return, you probably should because you spent your money already. You spent your CapEx dollars. Maybe you came in day one with a $2 million budget. Well, you burned through that in the first 2 years, and now maybe you've enjoying some cash flow. And it's just time to hand this thing off to the next operator. So there's been deals that we got a really good basis, incredible basis, and then there's deals that are more middle of the road that have some yield out of them that we're just going to take over. And the key I think is if a 1980s asset is trading hands every 5 years, it's getting or ought to be getting this fresh capital injection, and that's kind of what keeps these buildings going, rather than one owner that's just going to be in it for 15 years with the same LP investors. Investors want to see the deal cycle, owners want to see the deal cycle, and at some point these just need some fresh capex. So this was one of those deals.
Well, Devin, thank you so much for sharing your knowledge, your experience, your expertise with us here today. If listeners want to learn more about you or follow you, how can they do so?
Sure. Thanks so much for having me on, Whitney. I really appreciate it. They can go to djetexas.com and connect with us there.
Excellent. Well, again, Devin, thank you so much for your time here today. And we look forward to hearing about your future deals.
Let's do it again on another deal. Thanks so much, Whitney.
Absolutely.